Now that we have established what we mean by asset, liability, and equity, now we can move on to the next step, which is to understand what we mean by the accounting equation. So let's talk about that. The accounting equation. Believe it or not, understanding this is the most important thing in accounting. Like, this will affect every other topic that you're solving, literally like every other topic. So it is absolutely crucial, and you'll see from me explaining that I cover this topic in a very thorough manner. So what is an accounting equation? It basically states that assets are always equal to liabilities plus equity. So let's try to understand that for a second. This means assets, that means everything you own, is always equal to everything you owe, and let's say the money left over after you pay what you owe from the assets. So it actually does make a lot of sense, because if you think about it, right, when a business has an asset, right, it owns something. Either it came through a liability, right, means let's say if you have cash in your asset, you either got it through a liability, right, you borrowed the money, or you got it through equity, means it is your own money as a person or as a company, if we're talking about that. Now you might say, what do you mean by own money? Think about it. When you're a company, owners invest money into the business. Now this money for the business is its own money, it's equity for the business, okay? It's not a liability, because we are not supposed to pay back this money at a certain date in the future. No, this is the money that we have as a business that we can spend however we say fit. So that's kind of what the accounting equation is representing, which makes a lot of sense. Again, just to make sure we understand this, what you own is always equal to what you owe, because either you got the asset through a liability, or you got the asset through something that is actually yours, right? Like again, owner investing money into the business and the business giving shares. So that means that money that the business made by issuing shares, it's its own money, it's not liable to pay it back. So there you go, that's all you have to know about the accounting equation, because now we'll begin a format. This is the format I always use with my students, because this has worked tremendously. So if you notice, the format is basically showing assets are equal to liabilities plus equity. However, under assets, I have mentioned some of the asset accounts, so you get some practice out of this and you understand what's going on. And under liabilities, I mentioned an account called accounts payable, which you'll see a lot of in the future classes. And equity. Under equity, we have three things: capital, we'll talk about what that means, revenues, and expenses. So without any further delay, let's start the concept. But just to explain why we need to understand this format, is because this format will help you understand which transactions affect which accounts in what manner. So let's do the first transaction, so you see what I mean by this. Let's say owner introduced $100,000 cash into the business. So because if you are doing accounting from the for a business, this is always what happens, right? First, the business needs some money from somewhere. So owner introduces money into the business. So, and also another thing you have to understand, we always do accounting from the business perspective, right? We're not doing accounting from the owner perspective. You can do that, but again, you're probably not learning accounting to do business, do accounting for a person. You're doing it to do accounting for a business. So we are going to do accounting from the perspective of the business. So let's think about this. Owner introduced money into the business. So owner gave cash to the business. So for business, the cash will go up. So if you notice, I'm writing a positive 100,000 to suggest it's going up. And since this money is invested by the owner, it is under equity account called capital. Always remember, all of the money or all of the value we get from the owner into the business is capital. So that's the first transaction. So okay, so now we are starting to build some concept here. Okay, when owner puts anything into the business, it increases the capital account, which is just keeps track of how much money was introduced by the, let's say, to keep it simple for now, by the owner, and cash is also increasing, which is increasing by $100,000. Okay, now that's the first transaction. Let's go to the second transaction. And by the way, if what we just did is not 100% clear, it's fine. It's not going to be a problem for us, because the strategy that I will adopt to do this course, everything will become clear for sure, right? So don't worry about anything. This is normal when like you don't understand like little bit here, little bit there, but as we go along, you should be able to understand everything. And if let's say after we are done with the many topics and you still don't understand some of the things, then okay, you can look at the course again, and like let's say also a third time if you want, and then like it should be like perfect. So let's do the second transaction. So let's say after the owner put money into the business purchased a building for $20,000 cash. Now let's think about it. So we are buying a building, that means our building is going up, right? Because now I own that building, my assets are going up. However, another asset is going down, which is cash, since I'm paying cash. And if you also notice, this seems to always be two accounts affected, which is, by the way, remember, always true. Means it is not possible for a transaction to only affect one account, because we have this accounting equation, right? Assets are equal to liabilities plus equity. So if it affects one account, it has to affect another account to somehow balance the accounting equation. And it's very logical, you know, you don't have to consciously think about balancing it. That's not a good approach. Just logically think about it. Okay, I purchased a building for cash, what happened? Building went up, cash went down. You'll always get the right answer. Amazing. Let's do the third transaction. Let's say the business purchased a car for $30,000 on credit. Now let me explain that term, credit. Credit means I promise to pay money later. Since I'm buying it on credit, that means I bought the asset and I promise to pay the money later. So what will happen here is my car will go up because I just bought the car, and my accounts payable liability will go up, because accounts payable is a account which shows you how much you owe for, let's say, the things you purchased on credit. So I hope everything's clear so far. It should be. Again, if there's any problem, it will automatically get cleared out. This is a normal process of learning accounting. Let's do the next transaction. Let's say we paid the money back now for the car previously purchased. Okay, so let's think about it. If I'm paying back the money for the car I purchased in the previous transaction, my cash should go down, of course, by how much? 30,000. And my liability should also go down, since I've paid the money back now. I'm no longer liable for this amount. So this is how we like understand every transaction. Okay, I understand now. When I buy something, this account goes up, this account goes down, or like any combination of things. So we have to make sure that we understand the concepts, which accounts are affected, in a very good manner, because everything else will become a lot easier if we do that. Okay, let's do the next transactions. Let's say we provided accounting services for $10,000 cash. So let's assume we have a service business, right? We provide service and obviously we make money from that and receive cash. So in this case, what's happening is we provided someone accounting services and they gave us cash for those services. So of course, my cash should go up. But the question is, which other account will be affected? So here, you have to learn this term called revenue. Revenue refers to the money that you earned. Now, just to give you an introduction, earned doesn't mean you've received the money. Earned means you've done your work. Now you are entitled to that money. If you received it right now or you receive later, that doesn't really matter in you recording the revenue part. Of course, we'll talk about like how does it change the cash part, right? If I don't receive the money, of course, it wouldn't affect the cash account. We will talk about that. But remember, the moment you've earned the money means you've done the work for that money, it becomes your revenue. So in this case, our revenue account under equity will go up. Now let's talk about the situation that you might be thinking about. What if it was not cash? It means I did the work and customer will pay me money later. So let's introduce another account into this table called accounts receivable. Now accounts receivable, of course, is the opposite of accounts payable. Accounts payable refers to the money we owe someone else. Accounts receivable is the money customers owe us, right? So in this case, let's take the same transaction but change a little bit of detail there. Let's say we provided accounting services again to someone, let's say for $12,000 worth of money, but on credit, means we did the work and the customer promised to pay later. So in this case, of course, we know the rule. The moment I've done the work, I should record revenue. So my revenue will go up by 12,000. However, cash will not go up since I haven't received the money. So I have to think logically here. Okay, if I'm supposed to receive money later, which account should that affect? Yes, I'm sure you guessed it. It's accounts receivable. Accounts receivable goes up since I am now owed money because of this transaction. So that's kind of what accounts receivable tracks, the money you are owed from customers. Amazing. Let's do another transaction because I'm sure like all of this is very logical. Just again, if you're having trouble, just try to rewatch the video and follow along. It should be very easy. It should not give you any problems. Amazing. Now if I say customer paid the money back for the services provided previously. Okay, so now the customer is giving me the money back from this transaction, right? So of course my cash will go up since I'm receiving the money by 12,000 because we know it was 12,000 that the customer owed, and since the customer no longer owes us this money because they just paid, we remove that money from the accounts receivable by subtracting it by 12,000. So that's like how do you understand the revenue side of things, right? How does revenue affect different accounts? Now let's do the last thing that I wanted to talk about in this format, which is called expenses. So let's say we paid rent expense for this month, let's say, of $5,000 cash. Now we'll again think very logically. Because I'm paying cash, my cash goes down. And since we incurred an expense, our expense will go up. Always remember that the moment you have used an expense, you have to increase the expense account because we are recording that expense just to keep track of things. So that's what accounting is, right? Keeping track of what happened and all the transactions that took place. So these are all the basic transactions I always like to make sure that students understand. And now I'm going to show you something. Let's do the total of each account to show you that accounting equation will balance. If it doesn't balance, that means we have made a mistake, of course, because it's not possible for accounting equation to not balance. Okay, so these are the totals I've done here. And before talking about this part, also I want to add something. In case you don't understand what an expense is basically like, let's say, cost of running the business. Again, by the way, this is like a pattern recognition, you know, like when you see the cost of running business like rent, utilities, let's say wages, salaries, advertising, like you will get used to like, okay, knowing, okay, that's an expense, right? Like it's never a problem. Like please don't worry about thinking, okay, I will not be able to identify. No, you'll definitely be able to identify which are expenses because you'll see the same names, right? Rent expense, salary expense, wages expense. So you'll know this is an expense and this is not an expense. Like it's actually quite easy. Now let's see if the accounting equation holds true for this. What is the value of my total assets? Let's calculate that first. Okay. So value of my asset is this plus and then 0, 0. So 0 I don't have to add here. So assets are worth $117,000. Let's look at liabilities. Liabilities are worth at the moment $0. And let's look at equity. Now, if you notice something for equity, I am under equity accounts. I'm writing this very hidden formula here. If you can see, capital plus revenues minus expenses is what we mean by equity, which makes sense, right? Like revenues is when you earn money, so you have more, let's say, let's talk of it as net worth. Again, not the perfect way, but it will do the trick. So when you earn money, your net worth goes up, and we spend money on costs, right, like rent and everything, your net worth goes down because you are now you have less of the value. Okay, with that in mind, with that formula in mind, if I apply this formula, capital plus revenue minus expenses gives you equity. So if you notice, yes, accounting equation does hold true because my assets are equal to my liabilities plus equity, and that's it.